Hey everybody, Greg Barron here. Thanks for joining our YouTube channel once again, The Professor of Real Estate. And today we're going to dive into some meaty stuff, so you're going to want to stay with us. So the second thing I want to talk to you about is what are good returns? So I want to break it down into three specific areas. First off, what I look at is cash on cash. What is the equity multiple? And then the third thing I look at is what is the expected going out internal rate of return. The second thing we look at is equity multiple, and every investor is going to want to know, if I invest $1,000 here, what kind of multiple of that am I looking at in the term if I hold it for a specific amount? And again, it all goes back to what type of asset is it. On the lower end of the spectrum, if it's stabilized and we're only looking to hold it for, say, 3 years, my particular equity multiple is going to be between 1.5x and a 2x. On the other hand, if we're looking at this for a longer term, specific to multifamily, if we anticipate holding it for, say, 7 to 10 years, it's reasonable to say that there will be more risk in the life, so our returns should be longer. In addition to that, you're holding my investment money for a longer term, so I want my equity multiple to be larger. So on a 7 to 10 year hold, we expect greater than a 3x on our original investment. So let me give you an example of an equity multiple, just showing you two figures. I've already loaded this into Performa Plus. Now, there's a bunch of numbers that are on the back side of this, including development cost, building income, stabilization, and so on and so forth. But I want to draw your attention to two specific things to let you see what an equity multiple is. If you'll look right here, this will be the original investment, around $10 million of a cash investment. And then as we've run the numbers and done the sensitivity analysis, from an investor standpoint, this one will achieve a 2.18 equity multiple, or a total return of around $20 million in distribution over the life of the project. So specific to my previous example, that I wanted to achieve at least a 2x to investors over the life of project if it was a 3 to 5 year hold. You'll notice on this particular project, we went 5 years out. We achieved a 2.18 multiple, so it fits within the 1.5 to 2x of our equity multiple. Now, this is prior to looking at the total internal rate of return, which I'll get to next. So we've looked at cash on cash, we've looked at equity multiple, and the last item is internal rate of return. So just like cash on cash return can vary depending upon if it's a seasoned product, or if it's fully stabilized, or if it needs a value add, the same thing applies to internal rate of return. It just depends. Usually you want to look at something on a minimum of 8%, and maximum on internal rate could be 20% and higher for investors, which leads me to my next explanation of capital buckets. So investors normally identify capital buckets in 4 basic classes within a specific asset class. So again, taking multifamily as an example, let me give you the 4 capital buckets that usually apply to multifamily. These 4 are typically core, core plus, value add, and then opportunistic. So among these core bucket classes, the return that we expect usually goes from low to high in this order of core, core plus, value add, and opportunistic. As we go down each one of those, the risk for return and the risk associated with owning or developing gets a little bit higher. So it stands to reason our expectation of our internal rate of return, which is basically the sum of all cash flows, and then you add on the exit value to get your year-over-year return discounted back to the present value. So typically the lowest risk asset in the capital bucket class are the core assets. Now let's take multifamily for example. If it's an interior, CBD project, Class A, fully stabilized, you would normally expect an internal rate of return no less than a 7 and typically no greater than a 10%. The second asset is the Core Plus in this capital bucket exercise. Typically, these aren't in the CBD areas, but they're very strong class of asset, usually fully stabilized with a lot of history to it, and normally you can anticipate somewhere between a 10 and a 13% internal rate of return. Now, of those first two, Core and Core Plus, you find mostly institutional investors or insurance companies or family offices that are placing money in those particular assets. They don't want to manage them. They want them to be fully stabilized. They want a specific return. They want mailbox money. That's why the internal rate of return is more predictable and usually a little bit less than the next two that I'm going to describe. So the next capital bucket is what we call the value add. Again, let's stick with multifamily for right now, but this could apply to other asset classes as well. So this value add, specific to this capital bucket of assets, is typically something that is established. It's got a trailing history of income. It's got some opportunity to increase rent, but it's going to have higher risk than the other two prior classes. Normally, this capital bucket is going to require an internal rate of return of anywhere from 13 to 17% with the risk that you're going to take on with this particular asset. So this last asset class, along with the value add class, are two of the most classes where most people look to get a higher level of return. Opportunistic is going to have the most risk and therefore require the highest expectation of internal rate of return, primarily because the longer it takes to do a new development, the longer you open yourself up for potential risk. And there's no history of stabilization or a guarantee that that return is going to hit the mark. So typically in the opportunistic class that we're referring to, we're going to require anywhere from a low of 15% to 20% plus in the expectation when we develop our internal rate of return strategy for investing. So as we jump back into the software, I want to show you how a cap rate can affect the sales price and ultimately affect your ultimate return over the life. And a lot of you might be wondering just why buyers and sellers' expectations aren't aligned right now, and there's not a lot of movement in this space, and I'll show you as we jump into the software. So take a look at this same project, and I've loaded a 4% cap rate, which was pretty typical of a few years back of the multifamily space. And then we're going to look at a 6% cap rate, which is closer to what the expectations are today. So look at the difference just in the sales proceeds before tax. When this particular project was loaded, it had a going out sales proceeds before tax of $40 million based upon a 4% cap rate. Now fast forward 2.5 years later, and cap rates are moving closer to 6%, if not over, for this particular asset. And that same project that was going for $40 million is now only yielding close to $18 million in a going out sales proceeds before tax. That is close to $21 million difference just because the cap rate changed from 4 to 6. This is why we are in the market that we were in today, while we're not aligning buyers and sellers' expectations. Sellers are not willing to give up that $22 million yet, and buyers aren't willing to pay because they're waiting to see what that cap rate is going to be going out as we move along through this year. So these are the huge disparities that we're dealing with right now. And basically, it's a game of chicken. Somebody's got to move, and nobody's willing to just yet. But at some point, sellers' expectations have got to line up with buyers' expectations, and there will be movement in the market. Just not yet. Thanks for joining us again today. Remember, educate, evaluate, so that you can ultimately execute to increase your own personal wealth. See you next time.